Have you ever wondered how you're supposed to figure out what your specific portfolio mix should be going into retirement? Should you be decreasing your allocation to stocks ahead of time? What kinds of stocks should you even own? Do you need GICs? What accounts should you hold all of those things in? It can all be very confusing, maybe even intimidating. Left unaddressed, your portfolio can start to look a lot like a junk drawer filled with a pile of odds and ends, isolated holdings that lack a larger strategy. So in this video, I'm going to walk through a real-life case study of how we recently helped a new client in this exact situation who had saved about $2 million for his retirement. And you'll see the process and the framework that we walk through to analyze and optimize his retirement portfolio. You'll also see that none of the recommendations we made here had anything to do with how most Canadians manage their money with the big banks, and there are specific reasons for that, which I'll get into. And by the way, whether you have $20 million, $2 million, or $200,000, the principles that we'll walk through, the process that we'll discuss here, they're the exact same steps regardless of how much you have saved. So let's dive in and show you how to figure this out. And before we can do anything, we need to understand the situation a little bit more. The last thing we want to do is start with an investment mix. Whenever anyone asks me about my opinion on a specific investment, I'd be frankly guilty of malpractice if I gave them my feedback before we actually understood someone's goals, their income sources, and how they feel about risk. So let's start there. So I'd like to introduce you to Glenn. Glenn worked as a blue-collar worker in the marine industry. For most of his life, he earned a solid income. During his working years, he loved what he did, and so he actually chose for a later retirement. So he now finds himself at the age of 68. He owns his home. It's worth about $1.5 million. He doesn't have any debt on the property. He's got about $1.4 million in his non-registered account. He's got about $120,000 in his TFSA and about $435,000 in his RIF account. He recently converted over from an RRSP. Now, Glenn figures he's going to need about $80,000 a year of after-tax income coming in, and his spending is going to be decreasing over time based on that retirement spending smile that we've talked about in other videos. He'll be getting about 90% of his maximum CPP and 100% of his old age security, but because he delayed both of these with his delayed retirement, he'll be getting grossed up values, a little bit higher than he would if he was taking them at 65. Now you can see here, in the year that he turned 69, those grossed up values of CPP and OAS are going to bring in about $27,000 between those two sources. Now, best practice is for us to be running a RIF drawdown strategy here to ensure that his RIF is depleted at his life expectancy, so around 85. And so that has us drawing about $30,000 a year from his RIF every single year. And then the balance is going to be coming from his non-registered account. So if we look here, we can see that over the next 5 years, Glenn's going to need to draw about $150,000 from his RIF and about $200,000 from his non-registered account to replace his employment income. So when we look if this is going to work for Glenn, just at a high level, it does. Glenn's on a good footing. He should be able to confidently spend at that level throughout retirement without needing to sell or downsize his property. Now, his question originally was, do I have enough? And that's now been answered confidently. Now, many folks want to see more, right? Once this first question has been answered, they want to optimize their situation. What can be improved? So with this as a foundation, we can now turn to analyze his current portfolio. What's he currently doing? And this is where things got pretty interesting. So first of all, despite Glenn's solid record keeping, he couldn't actually track down an investment policy statement that had ever been drafted in the years past. Now, an investment policy statement, or an IPS, is a document that summarizes and prescribes what someone's overall asset mix should be based on a number of different factors. Ideally, it's not just a boilerplate document that gets spun out of the printer, but something that was thoughtfully created with intention. It should tell you how much of different asset classes or geographies you should have in your portfolio, mechanisms for rebalancing, all of that kind of stuff. So the first issue is that Glenn doesn't have that in place, or it doesn't seem to be that way at least. But when Glenn sent over his statements, we weren't entirely surprised to see this smorgasbord. 12 different mutual funds from 5 different mutual fund companies. The RIF wasn't much better. Many of these holdings were also duplicated in the RIF, and the same thing we found in the TFSA. Until now, the relationship Glenn had had with the person managing his portfolio at the bank was such that the person on the other side would just make recommendations each time they sat down. And they would often add a new holding without much clear rationale or reasoning behind the recommendation. More often than not, it seems based on our perspective here, that the holdings were added after a period of solid performance. And this, unfortunately, isn't uncommon. Many people will chase performance and they'll buy more of the stuff that's gone up in hopes that the rise will continue. The evidence, however, suggests that there's perhaps a better way, but we'll save that for another time. Now, I'm not making any comment here on any of these holdings specifically. They might be good, they might be bad. Who knows? That's not the point. What I am doing is pointing out that the way this portfolio was constructed clearly lacked intention and purpose. Clearly. And as a result, it led to a pile of inefficiencies. So what we did next with Glenn is we ran a full diagnostic on this jambalaya of a portfolio. And when we're doing that, we're looking at it through 5 key portfolio construction decisions. First, we're looking at broad asset classes, so fixed income, equity, real estate. Then we're going to organize all of the underlying holdings through the lens of a geographic allocation, so Canada, US, international developed markets, and then emerging markets. Finally, we're going to organize all of these holdings through the dimensions of expected returns. So based on what academic research tells us about the qualities of investments that have higher expected returns, what kind of exposures to those qualities does Glenn's portfolio currently have? And here's what we found. So starting with the overall asset class mix, Glenn's current portfolio was nearly 80% equity, 16 3/4 in fixed income, and the rest was in cash. Now, this was interesting because when we had completed his investment policy statement together, we found that his target mix should probably be closer to 70% in equity, meaning that he had almost 10% more equity than he probably should have. So we took that investment policy statement recommendation and we tested it in his financial plan, and we confirmed that yes, that reduced equity weighting still allows him to accomplish all of his goals with that proposed allocation. Essentially, he's able to take a little bit of risk off the table. So this was the first observation. Glenn could still get where he wanted to go and take a little bit less risk. Now, the next thing we looked at was his geographic allocation. And again, things here got pretty interesting. So on a look-through basis, if we peered through all of these individual mutual funds at the actual underlying holdings inside those funds, Glenn had a 54.5% allocation to Canadian companies. 38% was in the US and a tiny sliver of international businesses at only 6% and pretty much no emerging market exposure at all. Now, Glenn hadn't ever looked at his portfolio this way. All he ever saw was just the holdings, the mutual funds themselves. So he didn't know if this was reasonable or not. So what we did was we looked at the world through the lens of what's called the market capitalization. Now, this chart shows a map of the world, and then it lays out the relative size of each of those countries' stock markets based on their relative size against one another. Now, interestingly, Canada's stock market only represents about 3% of the world market cap, and yet it represented 54% of Glenn's portfolio. That's some pretty significant home country bias. Likewise, the US represented about 59% of the global market cap, and it was only representing about 38% of Glenn's portfolio. So this was the second biggest observation, was that his geographic exposures were meaningfully different than the weightings the market had naturally assigned. Now, next we looked at the total cost Glenn was paying to have his portfolio managed for him. We isolated out any service fees or advisory fees that he might have been paying, and we set those aside just so we could look at the product costs specifically. How much was he paying for just the investment strategy itself? And so here's what we did. We took all of the holdings, we tracked their management expense ratios, and then we ran a weighted average MER calculation to confirm the total weighted average cost of this strategy. It was about 0.9%. Now, this notably still ignored a whole other layer of hidden costs, the TER, the TER, or trading expense ratio, which for some of these holdings was as low as 0.02%, but it got as high as 0.27%, or 27 basis points. Again, was that good? Was that bad? Again, you can't make an evaluation on this stuff purely on the basis of price alone. Many other factors need to be assessed, but just for reference, a simple broadly diversified strategy with a comparable asset mix, a more optimal asset mix, would come closer to about 34 basis points or 0.34%, all else equal. So a small percentage difference, just 0.56% difference between those two figures, seems like a small number. But you run the math, and that's $11,200 of cost savings per year. Now for Glenn, compound that up over the next 20 years of his retirement, that single difference was going to cost him $506,000. So those were the 3 immediate observations after a review of Glenn's retirement portfolio. In our time together, we actually looked at a lot more detail since he enjoyed the conversation. But for the purposes of this video, those were the 3 biggest takeaways. Now, by this time, we built out Glenn's retirement income plan. We had reviewed his current holdings and we identified some of these gaps in his portfolio, perhaps in ways that might produce really significant savings for him over the course of his lifetime. If only it was as easy as now hitting the go button and implementing all of this and walking away. The next thing we needed to do was we needed to look at the tax cost of making these changes. Now, keep in mind that the RIF holdings and the TFSA holdings, they could be easily repositioned. But for the non-registered account holdings, you have to think about tax. And in Glenn's case, there were 3 holdings that carried with them large unrealized capital gains. Now, these were likely positions that he'd held for a little bit longer than the rest of the portfolio. And so at this point, we had a decision to make. Number 1, do we sell off these positions in favor of a lower cost strategy? If we do this, we're pulling forward a tax bill that otherwise wouldn't have been due. Or option 2, do we keep the positions with larger unrealized gains, and do we build an optimized or an improved portfolio around those positions and we factor them into the overall mix? Now, your decision here will be your decision. Again, I'm just providing a framework for you to think about these decisions. In Glenn's case, given his age and stage, and since we're already wanting to take some of that equity risk off the table, we agreed to realize these gains over 2 years, which allowed him to spread them out over those 2 tax periods instead of 1. This was going to result in him paying a bit of tax, but it made sense that we do this now before his OAS and his CPP fully kicked in. And he could then lock in the better fee savings, which he'd benefit from for the rest of his life. Now, the other thing that we did is we actually proposed donating a piece of one of those holdings that had increased the most in value, the one that had the largest unrealized gain. When Glenn did this, the capital gain that otherwise would have been due was essentially forgiven by the CRA, and he got a nice charitable tax receipt, which helped to offset the taxes that were due as a result of this overall repositioning. So there was 3 perks. He gave money away, he got a helpful tax credit when he needed it, and it allowed him to reposition the portfolio in a better position for his upcoming season of life. So now Glenn was comfortable with his retirement income plan. He had a more suitable household level asset mix. He found some fee savings, and he managed the tax bill associated with the strategy transition with some smart charitable giving. The final piece was figuring out how the portfolio should be allocated across different account types. Now, from the plan, we know roughly how much Glenn is going to need to draw from his RIF and from his non-registered account over the next few years. So the last step is creating the account level allocations and having buckets essentially in each of those 2 accounts so that his income stream is set aside and protected from the volatility of the markets. A very real risk for those approaching retirement is what's called the sequence of returns risk. And this considers the impact of a big decline of your savings and that savings ability to fund your retirement income for the rest of your life. So to help manage that, we'll set aside 3 to 4 years of income in something much more conservative, a short-term bond fund, perhaps high-interest savings cash, a laddered GIC, something that balances the liquidity that we need and removes the risk of that value fluctuating when we need it the most. Now, what that can mean, though, is that even though Glenn's investment policy statement for his overall portfolio suggested that he should have 70% exposure to stocks and 30% exposure to fixed income investments, the actual mix inside these accounts might be entirely different. In this case, his RIF wasn't 70-30, it was 30-70. It was flipped the other way after we factored in the cash that needed to be set aside to fund his lifestyle. So setting cash aside for future needs is one thing, but the other thing we want to keep in mind here has more to do with tax optimizing your assets by location. And what I mean by that is since his RIF is fully taxable on withdrawal, if Glenn needs to have 70% of his overall mix in stocks and 30% in fixed income, and we have 3 buckets through which to express that household level asset mix, we'll want to tilt the growth, the equity, the stock exposure towards the accounts that give Glenn a tax benefit. And that means more equity in his TFSA and more fixed income generally in his RIF account. We'll want to be smart about where we own the conservative stuff and where we own the growth stuff, not just looking at the portfolio as a whole, but making sure that each account is tailored to the way that we're going to withdraw them. So hopefully that was as helpful for you as it was for Glenn. I mentioned that about 85% of Canadians don't manage their money this way. The real number is probably far higher than that. The experience of reviewing a statement with this kind of random smattering of randomly selected costly mutual funds is all too common. I hope that helps shed some light on some of the intricacies of this process. If you'd like a second set of eyes on your asset mix as you step into retirement, we're happy to provide you some feedback through the context of that full financial plan like we talked about. I'll put a link in the description below for you to set up a time for us to have a chat. Otherwise, that's all for now. Thanks again for watching. I'll see you in the next video.